Thank you very much, Chair, for the introduction, and hello to everybody. I'm very happy to be here today and to speak to you from the Commission perspective on the issue of the banking union, and in particular on the Single Resolution Fund. I'm stepping in for a colleague who was on the program previously and who is also in the trilogue currently. I'll try to replace him best I can. I will start by very briefly saying some words on the backgrounds and what are the underlying reasons and also objectives for the establishment of the banking union, and then briefly introduce the Commission proposal on the resolution mechanism, and also say some words on where the negotiation stands currently and what are the main contentious issues under negotiations. So when the financial crisis spread to Europe in 2008, we had 27 different regulatory systems for banks in place, which were largely based on national rules and national rescue measures. Although we had, of course, some limited European minimum rules and also coordination mechanisms in place. But the pre-crisis framework was incapable of responding to the financial crisis, and particularly to its systemic nature. And there were, for example, no tools in place to deal with the collapse of large cross-border banks. And since 2008, the Commission has tabled around 30 proposals to create piece by piece a sounder and more effective financial sector. Better regulated and supervised banks will be stronger, will be more resilient, and operate to the benefit of the real economy at large. And this framework will also ensure that the private sector would bear the cost rather than the taxpayer for banks' mistakes. And it will underpin financial stability in Europe, which is a precondition for the sustainable recovery. But the heads of state and government of the Eurozone agreed to go even a step further in order to achieve a genuine economic and monetary union through a gradually evolving banking union. And banking union means transferring supervisory and resolution authority to the EU level and to allow for centralized action with minimal costs for taxpayers and the real economy. Participation in this banking union would be mandatory for all EU area member states. But however, it's not a closed club, so it's open to those EU member states which are willing to join. And the Commission is convinced that this can be done on the basis of the current treaty provision. And as a first element of the banking union, the single supervisory mechanism has been established with a core role of the ECB. And as has been said already, it will become fully operational in November, and the preparatory works are underway, notably as regards the balance sheet assessment, which involves the asset quality review, which is undertaken by the ECB, and an EU-wide stress test, which is coordinated by the EBA. So in a nutshell, the main objectives underpinning the establishment of the banking union include the fight against fragmentation of the single market, so ensuring a better allocation of capital, the break of the negative feedback loop between sovereigns and banks, to restore confidence and prevent bank runs, and to strengthen the overall financial stability through high-quality supervision and centralized resolution, which is swift, impartial, and predictable. The two elements of the banking union, so supervision and resolution, reside on what is called the single rule book, which is applicable to all 28 member states, and thus ensures that the same rules apply across the single market. What is now resolution? Although with the new CRD4 regime in place and the high-quality supervision by the ECB, we expect the risk of large shocks to the financial sector to diminish. But of course, it cannot be fully excluded. And therefore, a resolution mechanism is needed to complement the supervisory mechanism, which is ideally coupled with a public backstop, which would be fiscally neutral over the medium term. Resolution is not liquidation, but a procedure for banks in trouble which ensure that a bank is restructured so as to maintain its vital function for the real economy. The objective is to avoid that taxpayers foot the bill when a bank gets in trouble, and losses are instead borne by the private sector, so notably by shareholders and creditors. Therefore, the Commission put forward a legislative proposal in July last year to complete banking union as a matter of priority. And what are the main features now of this proposal? The proposed regulation built on the rulebook on bank resolution as set out in the BRRD, and thus must be fully in line with it. It establishes a single resolution board involving the Commission, the ECB, and the national resolution authorities, and a single resolution fund. The board is empowered to use resources from the single fund, which will ensure that the equal treatment of all banks across the across the participating member states, and so it will ensure the predictability and the confidence in the implementation of the single rulebook on bank resolution. And this will be particularly beneficial where banks operate cross-border and will lead to the elimination of current divergences in member states' rules and approaches. The powers of the board. The board is empowered to intervene promptly where the financial situation of the board is of a bank or a group is deteriorating. The decision to trigger the resolution procedure, however, has to be taken by an EU institution in the light of the so-called Moroni case law. In the proposal of the Commission, it is the Commission itself who takes this decision. And where the Commission triggers the resolution of a bank, it is the board to decide on the details of the resolution tools to be applied and also how to allocate the resources from the single resolution fund. And the board will also ensure that the resolution decisions are implemented faithfully by the national resolution authorities. The board may convene in two different formations. So one is the plenary session and one is the executive session, the composition of which is much more limited, so only including those member states which are directly affected by the resolution. The proposal also foresees for a harmonized toolbox in form of early intervention powers of the board, which are similar to those in the BRD, including the sale of the business tool, a bridge institution tool, an asset separation tool, and the bail-in tool. The Single Resolution Fund pools the funds at European level from all the banks in the participating member state. It will be owned and administrated by the board, and the single fund should reach a target level of 1% of the covered deposits over a 10-year period. The mission of the fund is to provide temporary funding support to resolution operation. And in the event that the ex-ante funding is insufficient to meet the expenses of the fund, ex-post contributions could also be levied on institutions. And those ex-ante and ex-post contributions would be also adjusted to the risk profile of each bank, again based on the rules set out in the BRD. When resolution involves national resolution authorities in non-participating member states, the rules governing the establishment and the operation of resolution colleges, as again set out in the BRD, continue to apply, also including the EBA's mediation powers. However, within the SRM context stricto sensu, the resolution board replaces the colleges, the resolution colleges. So, what is the state of play? As already said before, the Council and the Parliament have defined their negotiation mandates in December, and relevant trilogues have started in January, and are expected to conclude before the end of the current legislatures, which give us only a few weeks to reach an agreement. And as we speak, there is a trilogue taking place. What are the main or most crucial issues which are currently under negotiation? One of them is the scope of the application and the allocation of tasks between the board and the national resolution authorities. So there are various options on the table, whether to cover all banks or only the most systemic ones, or whether to go for a system which is similar to what we have under the single supervisory mechanism, meaning that the board would be exclusively competent for all banks which are under direct ECB supervision, and also including the cross-border banks. From a Commission perspective, we can say we have opted for the broader scope, as we have learned from the crisis that also smaller banks can have a systemic impact if they get in troubles. And we also assume that resolution will be less frequent as compared to supervision, which is a day-to-day task and which is not the same for resolution. Another issue is the governance of the mechanism itself. So in particular, what is the role of the Commission and the role of the Council? As I told you, on the decision to trigger resolution involves some discretion, and therefore it has to be taken by an EU institution. And we suggested that this is the Commission, whereas the Council, in its general approach, also included and provided for a role of the Council, which of course makes the whole system more complex. And we know that a resolution decision has to be taken very quickly, maybe over the weekend or in 24 hours, and therefore a compromise has to be found, or a compromise is under discussion in order to ensure that the decision-making process is as swiftly and as efficient as possible. Also, the governance of the board is an issue which is still under negotiation, so the role of the executive session and the role of the plenary session. As here, also the Council general approach provides for an extended role of the plenary session as compared to what the Commission proposed, based on specific thresholds. And also the determination of the condition for resolution, so the likeliness whether an institution will fail or not is still disputed. And also an issue is the issue of accountability, as here the European Parliament would like to have a similar interinstitutional arrangement as we have under the SSM, providing for accountability arrangements between the board and the European Parliament. And one of the most crucial issues is, of course, the funding. So the Commission proposal foresaw a single fund with full mutualization from day one, on the assumption that the board would have used private money raised ex ante and ex post from the whole banking sector. But the member states decided to provide for certain elements of the functioning of the fund to be resolved or to be set out in an intergovernmental agreement, which provides for national compartments and progressive mutualization over a time horizon of 10 years. The Commission believes that Article 114, which we used as the legal basis for our proposal, is a sound legal basis, and on which all elements of this single resolution fund could have been dealt with. But of course, one of the crucial issues is now to find a compromise on this issue, and this will also be one of the elements which will determine the ultimate success of the whole negotiations. Thank you very much.